Tammy, I think we are going live now, which is fantastic. So I'm super excited to be doing another live podcast with you. And I know you're down in Florida as a hurricane is bearing down on you. So I appreciate you making the time to make this work.
Dedication.
100-mile-an-hour winds coming. We have to podcast about federal retirement benefits. Let's get to our priorities.
Come hell or high water. And this is not a joke.
No lie. Well, as this is a live broadcast to all of our listeners out there, one of the things that we love to do is answer your questions. So Tammy and I can jam all the time on content. We have never run a short of that. But more important than our content is your questions. So make sure you're jumping in chat, throw your questions in, submit them publicly or privately, etc. So we can go ahead and address them. Tammy, is that okay?
Oh, that's wonderful. We excel at questions. That's yes. our forte.
Where we come to life. I love it. Yeah. Well, Tammy, what we want to talk about a little bit today is we're in October. We have a couple months left for this year. So a little bit, how do we maximize 2024? How do we maximize our federal retirement? There's a lot of changes potentially happening next year, right? We have a presidential election. We have tax laws expiring. So there's a lot of unknown things. But let's focus down on the knowns, the things that we know that we can help control and we can help kind of move forward. How does that sound?
Absolutely. I thought of something else that I'll bring up because it's not just the TSP. There's other ways to save money next year. We got open season coming up.
Ah, yes. I love that. And boy, Tammy and I, we preach on open season, and it's always a small number of people that want to take advantage of it, which I get it, right? It's a big change. I like my health insurance. It's probably Blue Cross Blue Shield, right? Because that's where most people have it, but you like it, you feel confident. It's scary making that change to another system. But Tammy, I got to say, I've helped a few people. You've helped a lot of people with this transition to a different system.
Yeah. I mean, I've put my family through a lot of guinea pig stuff over the years. Right. So I've probably tried 7 or 8 of the federal health plans. And I have to tell you, none of them are bad. Some of them are better than others. Some of them cost more. Some of them cost less. But they all have catastrophic protection. They all pay for preventative care with no out-of-pocket expense. So, if you have 2 plans that are almost the same, why not take the one that's going to save you $100 a month or more? Sometimes it's even $400 a month because I know some people that are in some really expensive plans that they don't need to be.
It's not a permanent decision, right? It's a 12-month decision. So if you enroll in the new plan and you don't like it, great news. Next open season, make a change. They're not kicking you out of the program. You're not in some special grandfathered program. You can just come back into the one that you were, or if there's a change of life event.
Yeah. Yeah, and I think the other thing people don't realize, especially if they've never changed their health plan, is that there is no pre-existing clause in the federal health benefit program. There never was. So you could be in the middle of treatment for stage 4 cancer and you can still switch plans during open season and they have to take you. Yeah. So if you can find a plan that provides more coverage for whatever it is that you're needing, you can switch plans next year and starting in January have coverage for something that your old plan didn't cover. So yeah, I really do harp on open season because everybody complains because the price is going up, the average of 7%. Blue Cross is going up between 12 and 14%, which is the plan everybody loves. So this is a year to really take a close look at the other plans because, like I said, there's national plans that cover you worldwide, just like Blue Cross, and they can be a better deal for you. Another thing that people don't understand is there's some restricted plans that are open to a lot of federal employees, such as the Foreign Service Benefit Plan. That's not just the State Department. That's DOD. That's Department of Transportation. There's a lot of agencies that can join that plan. It's an excellent plan, a lot less expensive. Nothing against Blue Cross. And if you sell Blue Cross insurance, I'm not saying nothing bad about it. But the high option or the standard option of Blue Cross, which is the high option, it's expensive because of who's in it. We have a lot of older retirees who don't have Medicare. They didn't sign up for it. They didn't think they needed it. So now they're in their 80s, 90s. There's thousands of them actually who are over age 100 in the federal retirement system, and they're driving up the price because when you get into your 80s, it's not uncommon to suffer 2 or 3 chronic illnesses. Yeah. It's not uncommon to have some really expensive health care, like having a stroke, taking a bad fall that you just don't recover from as easily when you're 90 years old.
Mm-hmm.
And that's really what's driving up the cost. It's not the quality of the plan as much as what it's costing them to run the plan. So get me off my soapbox.
Yeah, well, boy, I'm just going to add to it. Then I got to throw out there the pitch for the high deductible plans as well.
Yeah.
They are so underutilized, in my humble opinion. And people, they hear that word high deductible and they start freaking out, right? Now, Tammy, you look at this from inside the federal system. I look at this from outside the federal system. I actually have a high deductible, which is dramatically higher than the federal high deductible plans, right? But we look at it and say those high deductibles, we get a little scared on the dollar amount. But it's to your point, when you start making the switch, it opens up that HSA, the health savings account, which you can put money away pre-tax and use it tax-free in the future. It's not use or lose, which is fabulous. Your premium gets reduced. And when I talk to clients about all the time, just saying, hey, let's just take the savings in your premium. Like, that's it. Let's just put that in an HSA account. Nothing happens. That's all your money.
Yeah. And not only that, but in the federal plans, which is something else you probably don't get, you get a rebate of part of that premium that goes into your HSA. To the tune of, sometimes $150 a month if you're a married couple, $75 a month if you're single. So there's seed money going into that HSA account that you can spend. It'll grow tax-free. You can carry it over. So yeah, I don't know why people don't look at those, but I think it's like you said, it's the word high deductible that really
scares us. Yeah.
They have catastrophic protection just like every other federal health plan. So you'll only hit that limit and then you pay nothing. We had it for 11 years before we qualified for Medicare.
Sure.
And during those years, we did hit the catastrophic cap. And the plan we were in, we only spent $5,000 out of pocket because it was on my husband's side that we hit it. So we both didn't have to meet it. So we only had him to have to pay the $5,000 and everything was 100%, including his drugs, all the medications.
So, I mean, think about that. You get that potentially $150 a month, plus your premium is deducted by several $100 a month. Let's just say conservatively it's $200 reduced, right? Which I think is pretty conservative. That's $350 a month that you could be putting into an HSA times 12. We got $4,000 stuck away inside of an HSA in year one. Tammy, you do that for 10 years. That's $40,000 that you have saved. Plus, the HSA can grow.
On the earnings.
Right, on the earnings. And you had 1 year that was a catastrophic event. Okay, so I pulled $5,000 out. Okay, I still got $35,000 plus earnings that are tax-free in this account that I get to use in the future. So, boy, this is supposed to be on FERS and TSP. We're just going to spend the entire time on health insurance, right? That's how important it is.
I thought we were saving money, so I thought I'm going to throw that in because it's another way that frees up money to put in your thrift. That's a segue into the thrift.
Especially as inflation is super high, right? Groceries are stupid expensive. All of these costs are going up, right? There's a limit on how much your pay goes up. This is a really neat way you could make a switch and you don't lose benefits.
I was watching TV for a little bit this morning, trying to watch the hurricane, but they were talking about in one of the shows that, how when you go to the grocery store now, the price of that box of cereal might be the same, but there's less cereal in it. And the price of a gallon of ice cream is no longer a gallon of ice cream. It's like 3/4 of a gallon. Well, the same thing happens with some of the health plans. The price may not go up as much. However, look at the deductible. It may have gone up. Look at how much you're going to pay out of pocket. That may have gone up. So remember, there's several things that are gauging what you're going to spend on healthcare. It's not just the premium. It's your out-of-pocket expenses. It's what features that plan has. What does it cover? If you're someone who needs hearing aids, some plans don't cover it at all. Some plans will give you $4,000 every 3 years. So there's specifics you got to look at.
100%. What are your needs, right? I like to say insurance is like Baskin Robbins. You got 31 different flavors, right? You got to find the flavor that's right for you, not just think that every vanilla is going to be the same. Yeah.
Right. But it's really hard when I go into Baskin and Robbins because I get to taste like 5 or 6 of them. I can't make up my mind. So what you got to do is narrow down your choices. Say, hey, I don't want the fat-free one today. I don't want the sorbet. I just want the chocolate or vanilla. And so that's what you really got to do to make it easier to choose which health plan you got to be in. You got to narrow it down to your top 3 and then start doing comparison.
Before we switch gears, we did have a couple questions came in, our comments. One from TC. It says, is it worth to switch to a high deductible close to retirement, or is it too late at that point?
Well, my husband switched to a high deductible plan and retired the next year. because he retired at a relatively young age. So we were able to stay in that high deductible plan until we turned 65. So we were in it for 11 years. So it just depends on how close you are to Medicare age. Because once you have Medicare, you can no longer contribute to the HSA. If you have any of your health insurance, if you have TRICARE, if you're under your spouse's private sector plan, you can't contribute to the HSA. You have to just have the federal employees health benefit plan, and it has to be a high deductible plan to contribute to an HSA.
And not what we think is a high deductible. It has to be an HSA eligible plan. I know in the private sector, that's some of the issues that we have is there's some high deductible plans, but they're not actually eligible for HSA contributions. So the federal sector is really good about the high deductible plans do qualify. But if you ever have to switch out for any reason, that's something to watch out for. That's
right. That's exactly right. Yep. And you can use that money even if you're not in a high deductible plan. So once we went under Medicare, we had $14,000 sitting in our HSA. So I'm now using that to pay my Part B premiums with tax-free dollars. Who gets to do that?
You do, because you had good planning.
That's right. It helps to study this stuff, but I don't think anybody wants to spend as much time studying it as you and I do.
That's fair. That's fair. Well, Tammy, let's jump into this just a little bit. I want to spend just a little bit of time on some questions that we get from our listeners talking about their FERS contributions. Then I'd like to focus a little bit on the TSP, some things we can do, and then talk about maybe some other changes we should be thinking about this year and next. Is that okay?
Sounds like a plan.
Perfect. So your pension, right? You have three parts to your federal benefits from a retirement perspective, which are fantastic. Retirement income perspective. You have your pension, you have your TSP, and you have Social Security. So in the first pension, it's really cool because it's a defined benefit. The longer you work, the more of a pension you're going to get. It's your salary. It's your high 3 times the percent. And that's the formula the federal government puts together to determine how much you get. But Tammy, how much do federal employees pay in order to get this pension?
Federal employees know this because they look at their paycheck and there's a little line there that says FERS. And so that's your contribution towards that future pension benefit. For most federal employees, it's 0.8%. So it's a very small contribution, which I think a lot of employees equate to a very small benefit. And a lot of times they're very surprised at the value of that benefit, considering they only put in less than 1%. So the agency contributes the lion's share of the money that needs to be in there to fund FERS. But Congress got a little sneaky in 2012. They were realizing that the agencies needed money. Every year the appropriations bills eventually get passed. We're still waiting for that to happen. But so Congress decided they were going to shift some of the burden to pay for FERS from the agency budget to the employee paycheck. And they couldn't do it to current employees because there would have been a big fuss, right? The lobbyists would have been up on Capitol Hill in no time at all. So they said, we're going to make this for people we hire next year. So this was in 2012. So everybody hired for the first time in 2013, they're paying 3.1% into FERS as opposed to the 0.8%. And that went through so easily and so smoothly that they did it again. And Congress said, if you're hired in 2014, you got to pay 4.4% into FERS. And that's where we stand now. So anybody coming into federal service, they're contributing 4.4% into their FERS benefit, 6.2% towards FICA tax, and then hopefully 5% they still have left in their bank account to put into their TSP account or more. But we at least want them to put in 5%. No matter what, because they got to get the match. That match is free money you don't want to leave on the table.
Amen.
So it's tough. I feel sorry for brand new hires that are coming in maybe to GS7 or 9. It's really hard to pay rent, especially no matter where you are. I think rent prices are outrageous. So got to get a roommate.
Whether you are close to retirement or planning for it years out, one of the top questions that I get is, Micah, how do I fill out my retirement forms and not make any mistakes? This can feel a bit complex and overwhelming, and I understand that. You're making some pretty serious decisions that'll affect you for the rest of your retirement. Our How to Fill Out Retirement Forms series is your ultimate companion to navigating these forms. You are going to learn how to avoid common mistakes. You're going to learn how to fill these forms out correctly and even save money in the process. We will walk you through the most important steps so you can safeguard your financial future. Sign up today for this video series at planyourfederalretirement.com/retirement forms. That's planyourfederalretirement.com/retirement forms. Don't let the paperwork stand in the way of your retirement. Let us guide you through it step by step. Yeah, those are important though. I mean, what you're paying for is not only your pension, which is a huge part of it, but as Tammy and you are just talking about, you're paying for that health insurance for life. Because if you retire with the eligibility of an immediate pension and you've been in FEHB for at least 5 years prior to retirement, that pension allows you to keep health insurance into retirement. So it is expensive. Is it worth it? Probably, right? Even at that 4.4%, right? It's still advantageous to have. And again, states don't really have this pension anymore. It's still pretty unique to the federal government now.
Yeah, it is valuable. And if you look at how much a FERS retirement benefit is, and then you tried to figure out how much more would I have to have saved to create that kind of income, you're happy to pay that. Because like if your pension is $20,000 a year, even just a rough off the cuff calculation, wouldn't you need to have at least 500,000 saved to equal that for 20,000 a year pension? Pretty close to 400 grand of quick math. Yeah. 400 grand is what you need to adjust to a $20,000 pension. So that's a lot. And it's a pension. And that's not a guaranteed lifetime benefit. I was just about to say, yeah, the G word, which makes it even harder, right? Guaranteed. Yeah. Yes, ma'am. Right. Backed by the full faith and credit of the U.S. government, which you can't say that about your own savings account. No. So you got your first contribution. Now, it's good to know what it is, right? Because we want us to make educated and informed decisions. Really important. But Tammy, to your point, we can't control that. We can't say, hey, instead of paying in 4%, I want to pay 10% into my FERS in order to get a higher pension. It doesn't work that way. That's why it's a defined benefit. So the government defines what your benefit is. But on the other side, we have our defined contribution, which is this is now where we have some flexibility and we can fund our TSP. But you got to be careful because sometimes, Tammy, you and I run into a few mistakes, a few opportunities people missed maybe on the TSP funding. So one of the things is we always recommend, and we don't give investment advice from the platform because everyone is unique. The one thing we will say is everybody should be putting at least 5% into the TSP because you double your money. You get that 5% match under FERS, which is wonderful. It's common sense. Yes, ma'am. But Tammy and I, right before this, you and I were chatting about sometimes mistakes that we see, which is people get so excited about the TSP, they try to what we call front end load it. They're like, hey, I want to dump as much money as I can into the TSP in the first 6 months out of the year. Now, why would we want to do this? Well, mentally it says, hey, the sooner I get my money to work in the TSP, the more it has time to grow. So, okay, I can get behind that in concept, but we're missing a pretty important piece here, aren't we? Oh, yeah. Yeah, I had a woman that's been doing this for years because she liked the idea that towards the end of the year, she had all this extra money in her paycheck. She was so proud of the fact that she front-loaded her thrift until I told her that she's missing out on those last 4 months of the year matching. Because unlike other plans, the TSP is matched biweekly. So you put in 1%, the government puts in 1%. You put in 2, they put in 2. You put in 3, they put in 3. You put in 4, they'll put in 3.5. And then if you put in 5, they'll put in 4%. And of course, everybody gets the 1% automatic. So by the time you put in 5%, you're getting 5% from your payroll office going into that TSP account as well. So like you pointed out, Micah, that's 100% return on your investment, but you got to do it every 2 weeks. You can't say I'm going to put, $20,500 in January to June. You got to do it consistently throughout the year. Now, from a retirement perspective, from the lens I look at it, Tammy, and I know you do as well, I actually like level funding because it gets us on level paychecks. And when we have consistent income, we have consistent spending, it makes retirement planning a lot smoother. So I really don't consider this a downside, but where I run into it too, especially people up here in Alaska, maybe they came from the oil sector, then they went to work in federal service. And in the oil sector, private sector, the match can work differently, where it doesn't matter when you put the money in, as long as you put in enough, you get the full annual match. So sometimes you get people with that, they don't care when it comes in, which that's just not the case with federal employees. It does matter when it comes in. Right. It's a biweekly match. And it's hard to realize that until you actually sit down and explain it to somebody, because I've seen this happen a lot. And I think it's a fairly common thing for some people to not understand that. So that's really important. Yeah. That'll
Now,
make you some money right off the bat.
another thing to really think in mind, right, is one of the questions that we always get, which I think it's a good question to talk about because people get sensitive about this. And it's like, hey, Micah, when I retire, I want to be debt free. I want to have my mortgage paid off. I'm going to free up $2,000 a month if I pay my mortgage off. This is going to be great. And so they come into the concept of saying, hey, I got a $400,000 mortgage and I have $400,000 in my TSP. Bada boom, bada bing. I'm going to pull out my money from the TSP. I'm going to pay off my house. And I'm going to free up that $2,000, $2,500 a month mortgage payment, whatever it is. And it doesn't kind of work out that way, does it, Tammy?
No, and I've seen even worse than that. I had somebody wanting to take out $500,000 from their thrift. They were going to cover all their kids' student loans, pay those off, pay off their mortgage, be everybody's debt free in the whole family.
Right.
But now this is all pre-tax money. So next April, they got to pay the piper. And, the reason why we're saving pre-tax money is to lower our taxable income, or we think we're going to have lower income in retirement, so we'll pay a lower tax rate. And that's not true when you pull out $500,000 in 1 year, because now you've probably pushed yourself into the highest tax bracket for some of that money and much higher than you were while working for a lot of them. So, you're kind of defeating the purpose of putting away money pre-tax.
Yeah, if you're single, you're definitely in the highest tax bracket. If you're married, finally joint, you're in the second highest tax bracket. You're just probably right below that potentially in your income. So Tammy, you just went from paying 22% taxes to 32% taxes. That's like 50% more, by the way, folks, right? I mean, that's a big increase in the dollar amount we're going to give to IRS. So we really got to be thinking about the tax planning as we're saving. So as you're making your contributions this year, still not too late to change it. I was meeting with a new client today, and they're not max funding their TSP. And they just got on autopilot, Tammy. They've put it for a dollar amount. They just set up with that dollar amount. Life happens, all this other stuff. They had a bunch of kids, all these other things happen, which are beautiful, but then just never increased the TSP contribution. So, well, great news, right? It's only October. We still got a couple pay periods left. And so we're going to start catching up for this year. But then next year in January, we already got it marked on the calendar. We need to go back to that level payments. So we're getting all of that 26 pay periods funding in the TSP.
Yeah, and sometimes that can be overwhelming. Like when somebody's putting in $500 biweekly, and now all of a sudden you're telling them, let's put in $1,100 biweekly.
Right.
So that can be overwhelming. So even if you can't do that, go up a little bit, go up $100 and then keep increasing that every 6 months or every 4 months till you get there. Because I think sometimes we just throw our hands up and say, oh, I can't do that because then I can't put food on the table, or we got to eat hot dogs the rest of the year. So maybe you have to make it more manageable. Sometimes it takes that.
So I love studying money psychology, right? Because money is super emotional. And as you work with people, we find it out. If you ever had to deal with inheritance and family, money's emotional. Talk about budget with your spouse, money's emotional. So I love studying the psychology aspect of it, Tammy. And so I picked up a tip a long time ago from a money psychologist. And his comment was, we can handle a 10% change in our spending every 90 days. So what that means to me is just saying, okay, real quick, if you're putting in $500 into your TSP a month, great, go to a pay period. If you go to 1,100, that's huge. What if you just increased it 10%? What, just an extra $50, right? From 500 to 550. And then wait another 90 days. Let's see how that settles out. Then I love what you said. Let's just increase it again. Little baby steps to get to the right place.
Yeah, but you got to keep striving to get higher. And the same thing happens with the way some employees are invested. They started off, 30 years ago, putting whatever it was, 60% in the C fund, 40% in the G fund. And that's just what they did the whole way through, which may not be bad, but they've never gone back to rebalance the account through highs and lows. It could be a good thing. But then you have those folks that are 100% G fund the whole way, never understanding volatility or understanding how to manage an investment. And they're thinking, oh, I'm 100% G fund, I should be able to retire quite nicely. And they realize when they pull that money out of the thrift and add it to their FERS benefit and maybe their Social Security, it's still not enough to retire at 57. They may have to end up working till 62 to make up for the fact they didn't have the investment returns they might have had they been more balanced, better investment option. Yep.
Well, another thing to think about on this note too is something we're helping our clients out right now, and I love to do in the fall. Tammy, you and I talked about this a bunch, is Roth conversions. we will do millions of dollars, millions and millions, probably tens of millions of dollars of Roth conversions this year alone with our clients. And no, we're not trying to balance the national debt, right? That's not our goal. Our goal is to lower our clients' taxes over the next 10 years. And so in 2 years, well, less than that now, our current tax laws expire in 2026. Who knows what the new administration is going to do, right? Which way taxes are going to go. But we got to be thinking about that. So again, we're still in October. You can still increase your funding to your TSP. You can put Roth money inside a TSP if that's most appropriate. You could look at Roth Conversions, which is taking pre-tax money. Now, you can't do this inside of the TSP, unfortunately. This has to be an IRA account, potentially a 401k account. And you can convert that money from pre-tax into a Roth. Pro and a con, when we do this, we got to pay taxes on the money. That's the downside. If you're under 59 and a half, that means you probably can't have the taxes withheld. Otherwise, you're going to get your hand slapped with a penalty. So that means we got to have money to pay the taxes. But again, the way I'm looking at it, if my taxes are here today, and in 2 years, my taxes go up 20%, which they more than likely will under the current law, would I rather pay taxes here today or here tomorrow? Well, if it's here today, should we be doing more of those Roth conversions? And again, well, that's not a direct tax. That's not saving more money towards retirement per se. If I get less taxes, that's having more money in retirement, which is ultimately what we're solving for.
Yeah, that's a good suggestion. It's something we've been doing for a few years now too. I wish we would have started it earlier.
Yeah.
So don't do what we did. Start it now when you have the chance to do it. And like you said, if you can get the tax money somewhere else, then you can put that whole amount into the IRA, which is even better.
100%.
So,
yeah.
Got to be strategic.
Boy, Tammy, I don't think we got through half the content again, but I think we covered a lot of things, which is absolutely phenomenal. And we went through 30 minutes. So we want to be respectful of everyone's time. We did have another comment come in from My Dog Smells. That's a great username. And they do have, they said they would have done a high deductible plan years ago, but they're super happy with Blue Cross Blue Shield Focus. And I got to say, a lot of people really like Blue Cross Blue Shield, and we're not dogging on them. Even though your dog smells, we're not dogging on Blue Cross, right? It's a good plan.
I think Focus, well, I know that's the least expensive of the Blue Cross plans. And I happen to have the 2025 rate sheet in front of me.
Ooh.
Focus, here we go. Blue Cross Focus, for self only, it's $128 a month next year. For self and family, it's $303. That's pretty cheap for a family plan.
That's really cheap for a family plan. Nice.
And for two people, $275. So yeah, you can't beat the price. What you're going to find with some of the lower cost plans, like the value plans, the focus plans, some of the lower option plans, you'll have more out-of-pocket expenses. But if you're still in good health, you don't have any chronic illnesses you're treating, any big surgeries coming up, stay in it for a few years, until something goes wrong, then you can switch plans. But yes, take advantage of it while you can. It's still Blue Cross. You're still going to go see those preferred providers, which are everywhere in the world, basically,
pretty much.
Even overseas. So definitely something to look at.
Perfect. Tammy, we had one more question come in. TC writes in, they want to know if we can go over how a backdoor Roth IRA works. I love this concept. So this is the aspect that if you make, quote, too much money, by the way, it's like that song, right? I've never seen too much money. Theoretically, it might be there, but make too much money. The IRS says you cannot put money directly into a Roth IRA. You're prohibited. So back in 2010 is when this law changed. It allowed backdoor Roth IRAs. And the concept with it is, let's just say I'm going to make a $7,000 contribution. Well, I can't put that in my Roth IRA, but I can put that in my traditional IRA. But because my income is too high, it's called a non-deductible contribution. It gets reported on Form 8606 on your taxes. It's a $7,000 non-deductible contribution. Well, if the only thing I have is that IRA with $7,000 in it, because I just put that money in, 30 seconds later, I convert it to a Roth IRA, and now I got $7,000 going in a Roth IRA. So that's why it's called a backdoor Roth IRA contribution. You put it as a non-deductible IRA, it's then converted. Things to watch out for, let's say I have another IRA with any money in it that's pre-tax. Let's say I had $100,000 in a pre-tax IRA account, and I put $7,000 in after tax. Now what happens is now we have to have proportionate distributions. The math gets a little harder. So before you pull the trigger on that, talk with somebody who understands how this works, go through the math and still make sure it makes sense. If you don't have any other IRAs, well, it's kind of a no-brainer, great way to stick money inside of a Roth IRA.
Yeah, Yeah, it sounds underhanded, backdoor Roth, but it's totally legit.
It's 100%. We only recommend legal things, by the way, in case that needs to be mentioned. Everything is above board. It's 100% legal. And it allowed us again in 2010 to be able to start that. So
yeah.
Tammy, thank you so much for making time. Again, come hell or high water, you're putting it in there. So thank you for making time to join us today on the podcast. Pray for you guys and everyone down in Florida as this hurricane comes through, and hope it's all right.
It's going to be a big one, but I appreciate the diversion. I love to talk about benefits and love doing this with you because we can balance our bennies and bucks.
Yeah, I like it. It's fantastic. Okay. Tammy, thank you so much to all of our listeners. Till next time, happy planning.
See ya.